Before Jesse Livermore ever risked a single dollar of his capital, he subjected every potential trade to a rigorous and unwavering mental interrogation. He asked himself a series of foundational questions, a checklist so powerful that it served as the ultimate filter, separating the high-probability fortune-making opportunities from the reckless, capital-destroying gambles. This process was the very heart of his genius. It was what elevated his operations from mere plunging to the level of a scientific campaign. He understood that a speculator's greatest victories are not the result of a single brilliant hunch, but of a sound, repeatable process. To enter a trade without having first answered these critical questions was, in his view, an act of pure folly, a surrender to the whims of chance. He had learned, through the brutal tuition of his own catastrophic losses, that the market rewards discipline and punishes impulsiveness with a cold and unforgiving efficiency. These questions were not a complex algorithm, but a simple and profound framework for thinking. They were designed to align his actions with the market's primary forces, to ensure his timing was precise, to define his risk with absolute clarity, and to lay out a complete plan for managing the trade from inception to conclusion. They were his defense against his own human fallibility, a shield against the treacherous emotions of hope and fear. They were the four pillars upon which his entire speculative empire was built, and they are as relevant and as powerful today as they were a century ago. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. The first and most important question Livermore asked himself before any trade was this: what is the overall trend of the market? This was not a minor consideration. It was the foundational inquiry upon which all subsequent decisions rested. He knew, with an unshakable certainty, that the greatest profits were never made by playing for small, nervous fluctuations against the primary current. The big money, the fortune-making money, was only ever found by identifying the great sweeping movement of the market, the bull or bear trend, and aligning oneself with it from the very beginning. He stated it as a simple, almost childishly obvious truth. The thing to do was to be bullish in a bull market and bearish in a bear market. Yet he knew that this was the very principle that the vast majority of traders, in their eagerness for constant action, consistently violated. They would attempt to sell short in a roaring bull market, picking at tops, or they would try to buy bargains in a collapsing bear market, hoping to catch the bottom. Livermore saw this as a fool's errand. It was to fight an irresistible force, to stand in the path of an express train. His first job, then, was always to diagnose the character of the market as a whole. Was the great, underlying line of least resistance pointing upward or downward? This was not a matter of guesswork. It was a conclusion drawn from a dispassionate study of fundamental conditions, the state of credit, the health of major industries, the flow of capital, and confirmed by the behavior of the market's own leaders. He would study, he would analyze, and he would wait, often for months, until the character of the market was, in his mind, unmistakably clear. Once he had answered this first great question, it established the strategic direction for all his subsequent operations. If his analysis told him it was a bull market, he would not entertain a single bearish thought. He would not sell a single share of stock short. His entire focus, his every action, would be directed toward identifying and capitalizing on opportunities on the long side. Conversely, if he determined that a great bear market was underway, he would not buy a single share, no matter how cheap it seemed. He would only ever operate on the short side. This discipline prevented him from ever being caught on the wrong side of the primary controlling force of the market. With the great strategic direction established, he would then turn to the second, equally critical question. Is this the right time to act? This was the question of timing, the element that separated a profitable campaign from a costly and frustrating failure. It was not enough to be correct about the market's general direction. One had to be correct about the precise moment to make a commitment. To act too soon was to be whipsawed by the market's normal reactions, to have your capital and your confidence eroded before the real move began. To act too late was to miss the bulk of the profit. Livermore's answer to the timing problem was his masterful concept of pivotal points. He would not enter a trade simply because he felt the market was going up. He would wait with an almost inhuman patience for the market itself to give its signal. He would identify the critical price level, the pivotal point, at which a stock, if it crossed it, would be confirming the start of a major sustained move. This was his psychological moment, the point in time and price where his opinion and the market's own action converged. He had learned the catastrophic cost of impatience early in his career. He told the story of a time he was certain a great bull move in cotton was imminent. He was so sure of his analysis that he could not bear to wait. He jumped in, buying a large line, only to see the market stagnate and drift, forcing him to sell at a loss. He repeated this 5 times, his impatience chipping away his capital. Finally, in disgust, he gave up. 2 days later, the real move began, a massive, explosive advance that he missed entirely. It was $1 million lesson in the importance of waiting for the market's own perfect timing. This second question, then, was his ultimate defense against his own eagerness. It was a mandatory pause, a disciplined check on the impulse to act before all conditions were favorable. He would form his thesis, he would identify his pivotal point, and then he would do the hardest thing in all of speculation. He would do nothing. He would sit and watch, sometimes for weeks, waiting for the price to reach his predetermined entry point. Only when the market itself had confirmed his judgment by its own action would he consider risking his capital. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not confined to a single individual. The history of speculation is rich with masters who, while sharing Livermore's core respect for risk, developed their own unique styles. From the mechanical box theory of Nicholas Darvas, to the volume spread analysis of Richard Wyckoff, to the turtle trading system of Richard Dennis, from the deep value principles of Peter Lynch, to the pioneering trend analysis of Charles Dow and the modern psychological insights of Ed Sikota, there is a pantheon of genius to study. To explore this rich history, we have launched a new channel dedicated to the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding, the link to this new channel is in the description below. The answer to this second question was not a simple yes or no. It was a process of confirmation. It was not enough for a stock to simply touch its pivotal point. It had to cross it with conviction. It had to show by the character of its movement that the forces of accumulation had truly overwhelmed the forces of distribution. He would look for an increase in volume, for a decisive and sustained move away from the breakout level. He needed to see the market endorse his decision with its own powerful, registered action. Only when these first 2 great questions had been answered with a clear and resounding yes, when the great underlying trend was in his favor, and the market's own timing signal had been given, would Livermore even begin to consider the practical mechanics of a trade. He had established the strategy. He had confirmed the timing. He had put the great probabilities on his side. This disciplined two-step process of interrogation was what separated him from the crowd. It was the foundation of his confidence, the source of his poise, and the reason why, when he finally did act, he did so with a level of force and conviction that made him a legend. The third question, asked only after the trend and the timing were confirmed, was this: what is my risk? This was not an afterthought. It was a non-negotiable prerequisite to placing any order. Before he committed a single dollar, Livermore had to know with absolute certainty the maximum amount he was willing to lose if his judgment proved to be wrong. This was not a vague estimation, but a specific price point, a line in the sand beyond which he would not allow his losses to run. This was his stop-loss. He understood a principle that the amateur, in his hopeful optimism, perpetually ignores. You cannot control how much you will win, but you can always control how much you will lose. The market will ultimately determine the extent of a profitable move, but the speculator, and the speculator alone, determines the size of his loss. To enter a trade without first defining this point of surrender was, in his view, an act of gross professional negligence. It was to hand over the control of his financial destiny to the whims of chance. This question is the very heart of capital preservation. By defining his risk beforehand, Livermore was, in effect, purchasing an insurance policy against his own fallibility. He knew he would be wrong many times. It is the nature of the game. But he had structured his operations in such a way that his inevitable mistakes would only ever cost him a small, manageable, and predetermined amount. His losses were calculated business expenses, not catastrophic, unforeseen disasters. He stated, with the force of a man who had learned the alternative in the school of ruin, "A loss never bothers me after I take it. I forget it overnight. But being wrong, not taking the loss, that is what does the damage to the pocketbook and to the soul." By asking, "What is my risk?" and defining his exit point before he ever entered, he preemptively solved the psychological problem of taking a loss. The decision was no longer an emotional one to be made in the heat of battle. It was a strategic one, made in a moment of calm, rational analysis. The amateur trader, in contrast, thinks only of the potential profit. He does not want to contemplate the possibility of a loss, and so he fails to plan for it. When the trade inevitably goes against him, he is caught unprepared, his mind a chaotic storm of hope, fear, and indecision. He does not have a plan for retreat, and so he is overrun, his capital annihilated by a force he refused to acknowledge. Livermore's third question was his mandatory, disciplined plan for an orderly and strategic retreat. Only when he had a clear, unwavering answer to the question of risk would he proceed to the fourth and final question. How will I manage the trade? This was his campaign plan, a complete blueprint for his actions after the initial entry. A professional speculator does not simply enter a trade and hope for the best. He has a clear and logical plan for every contingency, a strategy for maximizing his success, and for recognizing the moment that success has run its course. The first part of this plan addressed the scenario in which his initial judgment was proven correct. If his probe, his first small commitment, showed an immediate profit, what was his next move? The answer was central to his wealth-building strategy. He would add to his position. This was the science of pyramiding, of reinforcing success. His plan was to buy on a rising scale, his commitment growing only as the market itself continued to validate his initial thesis. He was not just a passenger on the trend. He was an active participant, pressing his advantage with calculated aggression. This plan to pyramid was a direct consequence of his confidence, a confidence born not of ego, but of the market's own favorable action. He knew that the greatest profits were made from the great swings, and to capture a truly great swing, one had to have a substantial line. His method of scaling in allowed him to build this substantial line with the minimum possible initial risk. The market itself was financing his larger commitments through the profits on his earlier, smaller ones. The second part of his management plan addressed the exit. He had to know before he ever bought a single share the signals that would tell him the move was over. This was not a price target plucked from thin air. It was a set of observable market behaviors, the very same ones that formed his exit rules. He would be watching for the reaction without a rally, the sign of trend exhaustion. He would be watching for the definitive break of a reversal pivotal point, the mechanical signal that the great line of least resistance had finally shifted. This comprehensive plan, formulated before the trade was ever made, was what gave him his legendary poise. He was never caught by surprise, never forced into a state of panicked indecision. He had a rule for every scenario. If the trade went against him immediately, his stop-loss rule was his command. If the trade went in his favor, his pyramiding rule was his command. And if the great trend finally showed signs of faltering, his exit rules were his command. He had removed his own fallible, moment-to-moment emotions from the process. He was not reacting. He was executing a predetermined, well-reasoned plan. These 4 questions, then, form a complete hierarchical system of thought. They move the speculator from the broad strategic overview down to the specific tactical execution. The first question establishes the great primary condition of the market. The second pinpoints the precise tactical moment to act. The third erects the non-negotiable defense that guarantees survival. And the fourth lays out the complete offensive and defensive plan for the entire campaign. To ask these 4 questions before every single trade is to transform speculation from a frantic, emotional gamble into a calm, disciplined, and professional business. It is to replace hope with analysis, fear with a plan, and greed with a methodical strategy for profit maximization. It is a process that demands patience, study, and a profound level of intellectual honesty. But it is the only process that provides a true and lasting foundation for success. This was the framework that guided Jesse Livermore through his greatest victories. It was his mental checklist, his unwritten code of conduct. It was the source of his confidence, the architecture of his discipline, and the reason why, when he saw an opportunity, he could act with a level of force and precision that made him a force of nature in his own right. He did not guess. He did not hope. He analyzed, he waited, he planned, and he executed. This was the mental game he mastered, and it remains the only game worth playing.